Welcome, everybody. Lenny Hayes here from Trade Hall. Thank you all for tuning in. Okay, well, what a wild few days it's been. For anyone that hasn't been following the markets, been arguably one of the most tumultuous periods in recent history, and certainly for this year. Massive moves across all asset classes, especially bond yields, all triggered by the collapse of the SVB Bank, Silicon Valley Bank, in the US, along with Signature Bank, another smaller regional bank. And with that came a raft of contagion and fear around the US banking system, and a rush to safe havens. So we compared that to the environment and situation we saw prior to the weekend, and the turnaround in market pricing has been phenomenal. It's quite incredible the moves we've seen across bonds, especially, and we're basically going from looking at the Fed hiking by 50 basis points at the meeting next week to cutting and pausing, and the market calling an end to monetary policy tightening. So it was really staggering to see a situation like this. We haven't seen one of these before. Obviously, SVB Bank was the biggest banking collapse since 2008 in the GFC. Washington Mutual was the last one, but this did rustle a few feathers and sent shockwaves through the market. So look, just an overview of the money market at the moment. I don't know if you've been tuning in the last few weeks, but all these short-term bill rates are been up in the 5% range, and government bonds yielding upwards of 4%. So we look now in the low fours, and SOFR futures have turned around. Index swaps and things have seen a huge retraction. So let's get into what ensued in these days leading up to the collapse of SVB. So Silicon Valley Bank, based over in the west coast of America, has a very large deposits from tech companies, tech startups in that region, as you would expect, and tech heavy sector. They made up a broad majority of its clientele. So come Friday, I was trading in Friday. It broke that SVB was in financial distress and was in capital. Were a massive loss that they'd taken on government bonds. As you know, the bond bear market has taken a toll on many balance sheets. And SVB was reported to hold a large portfolio worth of government bonds, yielding very low rates. Obviously, the return they'll be gaining on that was a lot less than what it cost them to borrow from depositors. Therefore, having to liquidate that position resulted in a massive loss. To make up the shortfall of that loss, they plan to raise more capital through a further share issuance. Investors did not like this, and there was a massive sell-off in the shares on Friday, up to about 60%. As you can see here, this is the start of the contagion, and just a plummet, just a straight downward spiral for that share price. News spread quick, and investors soon became very skeptical on the banking system as a whole. For a bank to be losing that amount of money, it's very unusual, and rightly so, raises a lot of eyebrows. So, as you would expect, faith in the banking system in the US soon diminished, and in the digital world that we live in, and wire transfers and the ease of which you can pull money from the banking system, billions and billions of dollars were pulled from SVB and other regional banking institutions across the country. So this set off a massive risk-off event. We saw this eventually led to SVB being shut down by regulators on Friday, just before the close of business day. We'll touch on this next. But this led into the weekend. SVB was announced bankrupt. We saw first Signature Bank collapse as well, and a massive run on the bank, on many regional banks. So obviously, this was very sudden, and it was a huge shock to the financial system. The Fed and the US government was left reeling, and we're in crisis talks throughout the weekend to try and work out how they're going to settle this and how to stem the bleeding. When when markets opened again on Monday. So Biden, the Fed, and officials stepped in and announced that they were going to protect all deposits, even over the 250 grand limit, from the SVB depositories. So that really shored up the market and did reassure investors that the banking system was being looked after and was guaranteed and backed by the Fed. And did see markets really just get breath and regain a little bit of composure on Monday morning, especially in Asia. But look, the $2.5 billion loss, that was the turning point really. And Biden stepped in and insured all depositors. So they were really left with no choice. But that was the tale of the tape. So look, that's that really overshadowed a major data point that we were alluding to at the end of the week, the US non-farm payrolls. So leading up to that event, we were all skeptical of if inflation was easing, and in fact the labour force was cooperating with price pressures. Going by these numbers, it doesn't appear so. Still a greater than consensus result, came out at 311k compared to the survey. So in ordinary terms, you would expect to see yields continue to rise off the back of that number. However, the collapse of SVB and contagion around the banking system completely turned the market on its head, and we saw one of the biggest moves in bonds we've seen since 1987. A huge shift in yields. If we can just get a feel for how big this actually was, it moved a whole over 100 basis points from 5 down to below 4%. Peak to trough, we're looking at 21.5% move in a day or in 2 days, which is really unheard of, and back down to levels seen at the end of last year. And this was all off the basis that the Fed can't continue raising rates as aggressively as they are, as there's concrete evidence that it's breaking the financial system. And if we get a major financial collapse in the form of a bank or a major financial institution, that'll send the economy into a crisis. Look, that was the thinking. That was the thinking and market perception over the weekend and early Monday. We saw assets like gold spike dramatically as a rush to safer assets took hold. The Japanese yen, a safe haven, it appreciated quite strongly, as too did the Swiss franc, and the US dollar lost ground due to the situation at hand over there in the States. Another massive turning point that I just want to allude everybody to was the SOFR, or Federal Funds Futures. This was as of the 9th of March, so last Thursday. So as you can see, priced in another rate rise next week in March, and continued hiking up to the 5.5% terminal rate level. Fast forward to Monday, the 13th. Look at the difference in that. I mean, that is remarkable, the change we've sort of seen there. That's not even, I mean, let's look at Monday. So there is still the one hike, but marginal, and then a massive pivot in the curve, bringing in pricing in all these cuts later on in the year. So that's just that's a pretty good visual representation of what this whole situation did to markets, especially the rates market. Anyway, so we've touched on the dollar. We've seen the banking index, the regional banking index. It's taken a massive hit in the States. Slight recovery today, but all in all, a massive retraction. Another piece of data that was largely overshadowed once again was the usually important and closely monitored CPI print last night. It really was, it almost went unnoticed. However, a lot of market participants began to focus again on it, as investors were sort of wondering whether this SVB situation was an isolated incident and it was a result of poor management and inefficient hedging and just poor procedures and cash flow and capital management and monitoring was the cause of it, and not systematic risks in the industry. So if so, I mean, this doesn't really change the outlook for the Fed. It's consumers remain unscathed. The economy continues on and remains healthy. then what's stopping the Fed from continuing to raise rates until inflation is ultimately quelled? We saw last night, it came out broadly in line. However, the actual core CPI print month on month did beat estimates, which is the only upside in the reading as a whole. Everything else was as expected. It does then raise the question of, if we do see banks stabilise, and we got to remember SVB was a regional bank. It wasn't a global heavyweight. It wasn't, it doesn't, it's a big collapse, but it seems isolated at this point. And so really must be noted that there hasn't been anything else to really suggest that the Fed should cut as aggressively as what's being priced in, which is the other side of the argument. First Republic, another bank that was sold off and was teetering on the edge of collapse, it regained some ground today's session. It lose around 60%, I believe, but recovered an amount of, so that's 27% there. So, the scale of these falls are huge, but, the recoveries are on a scale of being pretty impressive as well. So we'll see how that pans out. And then, S&P obviously hit quite hard. Like all indices, has recovered again today, up about 1.5%. I believe 1.65% up today. If we keep looking on the long-term view, it still does seem like it's tracking in line with that downward trend. It's going to be interesting if it does keep dipping below well into the that slope that we've been touching on. It has bounced off this trend here and shown some sort of support, but look, we'll see what happens. I can't see a lot of risk appetite being priced in at the moment, considering what's happening. And if the Fed continues to being forced to raise rates, then I can't see much upside potential. And another big fall today was oil. It was down about 5% in the end, which was a huge fall. It's being blamed from seasonal demand and a glut in supply from oil producing nations. So that's a big faller. So keep an eye on there, but it does go to ease price pressures. So look, that's the major story. That's a major talking point now the last few days. I think we'll wait for all this to settle. I don't really want to touch on too much more. As you can see, the Aussie dollar did gain some value, but sold off heavily today as the US dollar begins to strengthen again. But I don't want to touch on too much further. Aussie dollar is actually falling away quite steeply now. This is the US dollar here, so sharp rises. So I think we need to wait and see what Jerome Powell and the Fed has to say about the next week's hike, next week's Federal Reserve meeting. That's next Thursday. So the commentary surrounding that will be important, and the rate that they deliver or don't deliver will be equally as important. So thanks all for tuning in, and all the best over the next few days.